Everyone thinks a company's financials tell the full story. They often don't. The balance sheet, the profit and loss statement, these are meant to be the bedrock of corporate trust. But what happens when the very numbers meant to assure investors are nothing more than a meticulously crafted illusion? This is the story of Satyam Computer Services, a titan of Indian IT, and the monumental fraud that exposed a $1.4 billion black hole. In the early 2000s, India was emerging as a global powerhouse in technology, and Satyam was a shining emblem of this rise. From its headquarters in Hyderabad, the company built a formidable reputation, providing IT services to major clients worldwide. It was seen as a symbol of integrity and innovation, a true Indian success story. Ramalinga Raju, Satyam's charismatic founder and chairman, was a revered figure. He was the public face of the company, a visionary who spoke eloquently of corporate governance and ethical leadership. His words inspired confidence, attracting both domestic and international investors to Satyam's stock. By 2008, Satyam was a Fortune 500 company, employing over 50,000 people across 66 countries. Its stock was a darling of the markets, and its quarterly earnings reports consistently exceeded expectations, painting a picture of relentless growth and profitability. Yet, beneath this glossy exterior, a different reality was taking hold. The first major crack in this facade appeared in December 2008. Satyam announced a controversial plan to acquire two companies, Mehta's Properties and Mehta's Infra, both owned by Raju's family, for a staggering $1.6 billion. The move was met with immediate and fierce opposition from shareholders. Analysts and investors saw the acquisition as a blatant attempt to funnel company money into Raju's family businesses, which were struggling financially. The outcry was so severe that Satyam was forced to cancel the deal within hours. This swift reversal, while seemingly a win for corporate governance, only deepened suspicion. The canceled deal was a tipping point. It had shone a spotlight on Satyam's internal dealings, and regulators and auditors began to look more closely. The pressure mounted, and it became clear that the carefully constructed house of cards was about to tumble. On January 7, 2009, Ramalinga Raju dropped a bombshell. In a letter to Satyam's board of directors, he confessed to what he called a fraud of unquantifiable magnitude. The letter, which quickly became public, sent shockwaves through the financial world. Raju admitted that Satyam's balance sheets had been inflated for years. He stated that the company's cash reserves of over $1 billion were entirely fictitious. Profits had been artificially boosted, revenues overstated, and liabilities understated. It was, in his own words, like riding a tiger, not knowing how to get off without being eaten. The scale of the deception was staggering. Raju confessed to fabricating over $1.4 billion in assets, primarily in the form of non-existent cash and bank balances. This meant that for years, investors had been pouring money into a company whose reported financial health was largely a fantasy. How did such a massive fraud go undetected for so long? Raju explained that the deception began subtly, with small adjustments to reported profits to meet analyst expectations. Over time, these small adjustments snowballed, creating a widening gap between the real and the fabricated. He and his brother, B. Rama Raju, who was the managing director, were the architects of this elaborate scheme. They used dummy companies, faked invoices, and even created false employee accounts to siphon funds and maintain the illusion of profitability. The fraud was deeply embedded within Satyam's operations. The internal audit committee, the independent directors, even the highly respected global auditing firm, PricewaterhouseCoopers, PwC, all failed to uncover the truth. The layers of deception were so intricate, or perhaps the oversight so lax, that the fraud remained hidden for years. The fallout was immediate and devastating. Satyam's stock plummeted by over 80% in a single day, wiping out billions in shareholder wealth. The company's reputation was in tatters, and its future seemed uncertain. Thousands of employees faced an uncertain future. The Indian government swiftly intervened, dissolving Satyam's board and appointing its own members to salvage the company. This move was crucial to prevent a complete collapse, which could have had far-reaching consequences for India's burgeoning IT sector and its global image. Raju and his brother were arrested shortly after the confession. The investigation that followed uncovered a complex web of financial irregularities, money laundering, and corporate governance failures. This wasn't just a simple accounting error. It was a systemic breakdown. The Satyam scandal drew stark parallels to America's Enron collapse, earning it the moniker India's Enron. Both cases involved massive accounting fraud, charismatic leaders, and a profound betrayal of public trust. The similarities were unsettling. In 2015, after years of legal proceedings, Ramalinga Raju and 9 other accused individuals were convicted. Raju received a 7-year prison sentence and a substantial fine. The verdict sent a strong message. Even the most powerful executives would be held accountable for corporate fraud. But the story didn't end there. The government-appointed board successfully orchestrated the sale of Satyam to Tech Mahindra, a part of the Mahindra Group, in April 2009. The acquisition, valued at $351 million, marked a new chapter for the beleaguered company. Under its new ownership, Satyam was rebranded as Mahindra Satyam and later fully merged with Tech Mahindra. The company slowly began to rebuild its reputation, demonstrating that even after a catastrophic fraud, recovery and redemption were possible with strong leadership and ethical practices. The Satyam scandal served as a harsh but necessary lesson for corporate India and beyond. It highlighted the critical need for robust corporate governance, independent oversight, and transparent financial reporting. Regulators tightened norms, and companies became more aware of their responsibilities. The case also underscored the human cost of such deception. Thousands of employees faced anxiety, investors lost their life savings, and the trust in financial institutions was severely eroded. The ripple effects of Raju's actions were felt across the entire economic landscape. The story of Satyam is a potent reminder that beneath the glossy presentations and soaring stock prices, the true health of a company lies in the integrity of its numbers and the ethics of its leadership. When those foundations crumble, even the most impressive structures can fall. It's a cautionary tale about the insatiable appetite for growth, the pressure to meet expectations, and how easily ambition can curdle into outright deceit. The Satyam scandal stands as a permanent marker in financial history, a testament to the enduring struggle against corporate greed. Uncover the true cost of unchecked power in our next exploration of corporate malfeasance.